Morning. Hi. Hey. Hi everyone. Very warm welcome to Bowman's today. It's a pleasure to have you with us here for this discussion, Data Transparency and Trust, SAWEM Needs to Succeed. The commencement of the South African wholesale energy market represents a significant shift in South Africa's energy sector, but its success is not guaranteed. It depends not only on market rules, on the quality of data, forecasting discipline, trading readiness, and the confidence that participants place in the decisions they make. Today's conversation is therefore not just about market design, it's about the practical foundations of trust, price discovery, liquidity, bankability, and credible participation in a changing energy market. We are fortunate to have an excellent panel to help us unpack these issues from policy, operational, legal, commercial, and trading perspectives. We'll hear from Cornel Claasen, manager at the Energy Council of South Africa, who will place SAWEM within the broader reform journey and explain why a phased framework is needed. Olga Suchkova, associate director at Cresco, will address market confidence, project bankability, and the credibility of price signals, particular focus on data transparency and institutional trust. Alexandra Felekis, one of my own personal mentors and partners here at Bowman's, will explore the legal and contractual implications of relying on data in a trading market, including accuracy, liability, reporting obligations, and dispute risk. Rob Futter, advisory partner at Cresco, consider the increasing complexity for energy consumers, including what good forecasting data looks like and how forecasting errors can translate into operational and financial risk. Grant Rolfe, commercial lead at Envusa Energy, who will speak to SAWEM trading readiness, from systems and strategies to bidding, portfolio management, and risk mitigation. Lastly, Mark Sims, head of power trading at Solar Century, will bring lessons from SAPP, including the practical realities of data availability, market participation, price discovery, scheduling, settlement, and cross-border trading. Thank you again for joining us today. We look forward to a practical, candid, and engaging discussion on this critical topic in our industry. Thank you so much.
Thank you so much. Good morning, everyone, again. Just a little preamble to the presentations. Some of what we're going to talk about, I think, is what we're aware of today under the market rules and various regulations. Some discussions around where we think the market rules will go. The others around what we see in other countries, which we think will definitely flow down to South Africa. But I think all of this must be held against the context of where we actually are in the South African grid. So we have too much energy at a certain part of the day. We still have less energy, specifically in the morning peak, which we'll talk about. And the grid is still unstable, but for different reasons that it was years ago. And that requirement for more instantaneous data is increasing all the time. One of my large clients that I work with in the Cresco side is currently signed up to IDR events, the instantaneous demand response. There you have 6 seconds to basically switch off your smelter. That is too quick, even for human interaction, never mind to read the WhatsApp message, walk to the panel, flick the switch. So that's the level of granularity that potentially eventually we'll get to. But we need the basic building blocks now, so eventually we can get there over time. That's just sort of how we see the trajectory going. Thank you very much. Now, remember to start with a joke.
Hi, morning, everyone. Lovely to see so much interest in SAWEM. So I've prepared 20 slides on the 1998 white paper of SAWEM. No, but luckily, there's your joke, Rob. We knew then that the sectors internationally are changing, and we can't fund the reform with a vertical utility. We had to unbundle, and we had to broaden participation. But with broad participation comes a complexity that you need to coordinate that is taken for granted in a vertical utility. So all of a sudden you need to have investment signals and coordinate it, have better system dispatch, visibility, balancing, risk allocation towards all the participants fairly and equally, and clear price formation, not just to drive investment, but to lower the prices and stimulate efficiency. And all of this within transparency framework that would create confidence to all participants and enable participation and coordination we need. So SAWEM is that coordinating framework. We often consider it the central reform, and it's a key priority at the Energy Council of South Africa. I'd always like to call it the reform catalyst. It puts in a lot of things we need, and it requires these to be in place that, for example, would avoid frivolous trader rules or debate outside. It's already covered within SAWEM. So the Energy Council has an MOU with the department, and we currently working together on SAWEM implementation and launch. And beyond that, the Energy Council also has established a standing committee. We drive a lot of initiatives. We've worked with the likes of Cresco and Bowman's towards project bankability to test the market code and its compliance to the ERA Amendment Act. We've developed and are developing continuously readiness frameworks, risk framework, to make sure we can support a credible roadmap based on readiness, not just pragmatism. And over and above that, we're also ensuring that when we consult on important things like the upcoming vesting framework, we don't just consult on the details, but we can make sure the framework's actually moving towards the intended outcome of the reform. It's based on clear transparency principles, and that it promotes efficiency and prudency within the sector. So I think you kind of upset a lot of scientists when you just introduce a bunch of variables at once. So typically, SAWEM isn't different. There's a lot of complexity. There's a lot of moving parts, instruments, and we can't just dump a completed market on the sector at once. So for that reason, we're also phasing in SAWEM piece by piece. And so far, it's going well. We've seen a lot of progress from NERSA and these consultations being out. So our view is still that we can make a 1 April launch. There is a lot to be done, but we're making good progress. And we just need to keep at it and make sure we also participate and not just be observers in an electricity reform, but help shape it. So at the moment, the market operator has launched the day-ahead market platform. This is what we would consider to be phase 1A. So Eskom is trading to Eskom within this market platform. We would have liked to see more transparency, more data coming out of this, especially from your dispatch and grid, not necessarily pricing at the moment because vesting frameworks are not in place yet, but it's still under development. We know the market operator is still developing the intraday market. So these things are not fully transparent as we wish, but we're making good progress towards then what we would call phase 1B, or where we actually start seeing price discovery, where vesting contracts are in place, the wholesale tariffs have been unbundled. And from that, you would also start to not just guess on your balancing obligations, but you would actually see a price connected to it. So once the balance simulation is planned to take place, participants or future participants can use the system as a mirror and see indicative outcomes for their balancing positions. And that can happen beforehand, but we won't really know our exposure until we actually see price transparency from 1B. So from this stage, we would expect the market operator to publish the daily adequacy report with reserves, capacity, the demand outlook, and they must also publish the algorithm for the co-optimization and dispatch. So we would start seeing a lot of data coming through, a lot of transparency we need for confidence and coordination in the market. There are still risks, however. We know there's a lot to be done. We know NERSA isn't always fully capacitated, but they are struggling with the concepts. They're doing quite well, not struggling in a bad way, but engaging and grappling with the concepts. Our key issue at the moment is how this vesting framework is set up. If, for example, the split between capacity and energy is not correct, we would see distorted price signals, and it would undermine not just SAWEM itself, but the entire energy sector, including all the bilaterals we have at the moment. So part and parcel of that would be the principles that it's developed with. So if we refer to revenue benchmarks, are we going to see those? Are they being published? How much transparency would we expect? And that's not immediately clear in the framework, and something we all need to collaborate and comment on. So a very short period, because Rob he runs a tight ship. The key message is SAWEM is on the way. It's not a 98 white paper anymore. We've come a really long way. Load shedding definitely complicated the reform. We may have opened to private participation and competition before some fundamental instruments were in place. But SAWEM addresses a lot of those issues and uncertainties. But if you cannot prepare and use your data and navigate this change in environment, you won't understand your exposure. You will need to focus on building not just capacity, but actual capability towards understanding everything in the sector, and whether you're a market participant or not, you will be impacted by balancing at the very least. So part of that is we have to engage early. We have to consistently engage with the material, engage with the consultations, NERSA publishers. And while I'm talking about engage, chat with me afterwards. It's hard to summarize the whole sector in SAWEM in just a few minutes. So always keen to chat and engage, and we welcome it. So thank you very much.
So because Cornel saved time, you get questions.
Yeah, you said 6 minutes, Rob.
So
I'm on 6 minutes.
Well, be nice. So I have a question, and then obviously, if anyone else in the floor has a question, please ask it. I'll bring the mic. NERSA capacitation. So they issued their plan for the year. Clearly, they're trying to get bonuses. A lot happening by September, October. Market rules, trading rules, rules, vesting contracts, right? They're clearly not going to be playing much golf. How do we see NERSA actually being capacitated? Because you need a lot of financial, technical understanding at the base level to actually get to this. It's not just about policy.
So there's a few aspects. They are working with international organizations. I don't think GIZ might be one of them. I'm not dead sure. NERSA likes to close their doors and keep it shut. So it's not like we go drink coffee there every week. But they also spread a lot of the work towards, for example, the market operator and the NTCSA. So a key example was NERSA was expected to publish the market code with its associated rules, but they instructed the NTCSA to provide them with the associated rules. And a lot of the work we've done early on, for example, also supported that with Bowman's. And instead of, for example, having balancing in the market code, it should be its own separate rule to make sure it's more enforceable across the sector, because not all participants in the wide sector are market participants. The other key issue for NERSA would be capacitating or developing their market oversight capability. It's going to be very important for them to understand not just supply and demand, but have a long-term outlook on price formation, have detailed modeling on how these prices not just end up in the market itself, but through the wholesale tariff to all end users. And that's part and parcel of their mandate. So that's maybe the biggest thing, is developing modeling capabilities. And it's not just NERSA, the department themselves will need to have the same capability. The way we use Section 34 at the moment will completely change, and they will have to preempt market failures. So you can't react to a market failure the same year it happens. And for that same reason, you will need really good forecasting tools, and not just from one company. I think it will be upon all of us to have views on price formation, on different demand outlooks. I mean, at the moment, like Rob said, demand is quite an issue, and if we sit with low GDP, I mean, we still have, we'll just have different issues that we're dealing with, but we can't just keep expanding without having clear vision on, for example, coal decommissioning or robust demand outlooks.
Thank you. Any questions from the floor? Is there a hand? Thank you for your presentation.
Thank you, everyone.
One, can you hear me? Okay, so I just wanted to talk basics really, and maybe lay the foundation for today's discussion. And obviously the topic for today is transparency, trust in the system that we're trying to create, trust in the platform, price discovery. Sorry for the busy slide, I'll take you through it. So when we talk about SAWEM, obviously it is a platform. It is there to facilitate the sector. It is there to provide a tool that can get us to where we're trying to get. So from that perspective, we need to ensure that it does exactly that, right? So one of the key roles of a market operator is obviously to provide the tool, is to provide the platform, but that's not enough, right? We need to make sure that that the market confidence is in place. Market operators across the world typically aim to improve trust, efficient decisions, and lower information asymmetry. So from that perspective, the goal of a market operator is to facilitate exchange of information, is to provide access to information, and ultimately to ensure that there is trust in the system and in the platform, and most importantly, in the price discovery. Data transparency obviously plays a pivotal role in that. And if you look across the world, you will see that a lot of effort is being made to ensure that the core market and system data sets are being shared with the broader, not just with the market participants, but with the broader general public, right? So from that perspective, there tends to be easy access, open access to all the necessary data for the analysts to use, to scrutinize, you know, the actuals versus what was planned, the forecasts. And that proves to be very important for the general trust and confidence in the system. So from SAWEM's perspective, you can see that, if I can, yes. So from the SAWEM's perspective, obviously there are all those different things that can be shared with the market participants and the broader public. Unconstrained schedule, constrained schedule, outages, ultimately the system marginal price, the ancillary service data, including payments, pre-dispatch and short-term forecasts, demand profiles, balance, imbalance outcomes, updated intraday schedules, and then obviously the congestion data. So all of this information, there needs to be a way to share that data, and there needs to be a way for market participants to easily access that data and be able to analyze it. So from transparency, from transparency perspective, that will have a direct impact ultimately on the success of SAWEM, and more importantly, SAWEM liquidity. So obviously we cannot expect that everyone will rush to SAWEM as soon as the doors open. At the end of the day, it needs to make financial sense. People will not risk it until, as I say, there's confidence in the system and there's confidence what you're exposing yourself to. So from that perspective, we do see that the liquidity will gradually grow, and that is going to be one of the biggest challenges, right? Once we commence SAWEM, how do we ensure that this confidence is growing and liquidity ultimately is growing as well? So from the transparency perspective, you can think of it from a stack thinking it of from this pyramid perspective. So at the very basic level, you have operational visibility. So from a market operator perspective, it is important to ensure that there is sufficient visibility into demand, available generation, dispatch generation, transmission constraints, etc. So your very basic layer of data needs to be shared with the market and with the sector and with the stakeholders. And I think this is to Cornel's point. There are certain developments already taking place in SAWEM, and it would be nice to start seeing some outputs coming from those developments. The next layer are your market outcomes, right? So using that operational data, that operational level layer, now SAWEM starts creating pricing, cleared volumes, balancing price, accepted bids and offers. So all of that information also needs to become readily available. The next layer is settlement and credit, right? There needs to be trust in the whole settlement process. It needs to be transparent enough. Ancillary charges, imbalance charges. So all of that just this is the next layer of that transparency. And there needs to be, as I say, there needs to be trust in the whole process and this dispute resolution. Everything needs to be transparent. The next layer, system forward view. So that relates to your forecasting, a very important role that market operator and system operator play. They tend to provide forecasts, both for demand, but also for outages, for network constraints that they see. And again, this information needs to be fed into the market so that market participants can use that information to basically adjust their positions in the market. And last but not least, and maybe even the most important one, is governance and assurance, right? So there needs to be visibility into rules, level playing field. We need to have confidence that everyone is playing by the same playbook, and most importantly, there is it's auditable. At the end of the day, we need to see some reports from independent parties, doing the market monitoring and ensuring that the market is operating properly. So all of that will create trust in the price discovery, which is the ultimate goal that we're trying to achieve from a bankability perspective. You need to have certainty in the revenue, and for that, you need to have certainty that the way the price gets formed and discovered in SAWEM is basically you can project, you can forecast it yourself, and if you didn't quite if you got your forecasting wrong, there are good reasons for it, right? So it needs to be, from that perspective, there needs to be trust in price formation, because those credible price signals, they will ultimately drive bankability of projects. And last slide, really just to give you some examples from across the world. Australia, Europe, Canada, United States. Just some examples. It's very detailed, but really, if you go through it, you will see that it's basically the same message, right? All those market operators across the world, they spend quite a lot of time setting up the systems, setting up a way to share data, creating dashboards, making it easy for stakeholders and market participants to read the data. The formatting is very important, machine readable formats, so to facilitate the whole, analysis of the data. And obviously that just creates some lessons for SAWEM, how to approach that topic. We do understand that SAWEM, or the market operator in South Africa, will not have everything perfectly in place on day one. But at the same time, from a transparency and trust perspective, it is important to see a very clear roadmap, how how that transparency is going to be ensured and how that data exchange is going to be developed. So we do hope to see that being developed, and we do hope to see that kind of communication coming from the market operator. Thank you.
Quick comment, and then if there are any questions. So you talked about machine readable formatting. I mean, it still blows my mind that NERSA approve a 30-page PDF that then either depending on your OCR recognition software or your data analyst skills, someone has to put in, that needs to convert so people can upload tariff engines really easy. So at a basic level, we even got to start there to make this work. Questions? Not very engaging, Olga. Alex, you can wake them up, please.
Morning, everyone. So I'm Alex Felekis, if you haven't met me, and I'm a partner here in the project's energy and infrastructure team at Bowman's. And Olga set the scene in terms of how the transparency of data is so important for the success of SAWEM and of the market trading platform. And I was actually thinking in my prep last night, the conclusion I actually came to is that the market trading platform is data. That's all it is. It's the exchange of data. So what I'm going to touch on now is the obligations of the parties that actually participate on this platform and what the consequences are when, through no fault of their own, those parties actually can't comply with their obligations, and then talk you through what we think are your contractual and then maybe practical mitigants. Okay, so firstly, in respect of the market operator, and Olga has touched on it, but just quick recap. So the market operator has to establish the system, maintain the system. From a practical perspective, what does the market operator do? Has to ensure cybersecurity. How do we get confidence in that as the private sector that's buying and selling energy on this platform? Is effectively there'll be biannual audits to actually check that all of that cybersecurity in place, and there'll be a data and information protocol that they will have to align with. As part of that protocol is that the information must be publicly accessible to all market participants and the wider public, machine readable, as Rob was saying to you, that there's a lot to be said in that. It's not very linear, it seems. There must be automated processing, and it must be available via accessible interfaces. What I'm going to talk you through is the last one, which is it must be published timeously or as soon as reasonably practicable. And what happens if the market operator cannot, in fact, publish something timeously? Who actually bears that risk? Now, from a participant perspective, the key word is accuracy, okay? What the rules basically prohibit is any false or misleading signals, any manipulation of information, or dissemination of misleading information. Now, very important is that the MSU will actually regulate this. And I don't think that it's actually a very straightforward task in order for them to do so. The more that the market actually is functioning and the more liquid that the market is the only way that the MSU would actually be able to identify this sorts of conduct. Some of it will not be explicit. What's important to know as a participant on the market is that although there are methodologies and there's a whole dispute resolution regime that's contemplated in the code and will probably be in your participation agreement as well, the market operator does not warrant data correctness or any sort of commercial reliance that you should have on it as a market participant. So any losses that you incur as a participant arising from forecasting errors, imbalance exposure, or market conditions remains with the participant. In fact, you do not have a claim against the market operator unless you can prove that they acted with reckless or willful misconduct. That's a very, very difficult burden of proof. So now I'm going to talk you through what if everybody tries to do their best and it's not their fault that they actually cannot share the data on time or in the form that they should have. What we did is we looked at 3 different jurisdictions in terms of how often force majeure or system failure events have occurred. And the good news is it actually doesn't happen often, or at least it hasn't in the last 10 years. So you'll see there's a few incidents, and we looked at Brazil, the European Union, and the United Kingdom. And you'll see there's 1 or 2 incidents in the last 10 years. And some of them were force majeure, but most of them were actually system failure in terms of some sort of cyber risk. Now, we then looked at the relief available in each jurisdiction. And what you'll be happy to know is in this way, actually the market code aligns with what happens in all 3 of these jurisdictions in terms of how this is actually regulated when it occurs. And I'm going to talk you through it now, but with a focus on South Africa. So what do we have in our market code? We've got provisions for force majeure, and we've got something called system failure. Now, force majeure, usual definition, everyone in this room has interrogated it many times. Events beyond your reasonable control, and there's a list of what force majeure could effectively be. And if a force majeure event occurs and prevents a party from performing their obligations, they aren't liable for any failure or delay. And what our market code says, other than the obligation to make payments of money, okay? Then we have the definition of system failure. Now, very much also, I mean, system failure can be derived from force majeure or not. What it is the unavailability of the market operator systems to accept any schedules, and because it can't accept any schedules or revisions, actually schedule the day ahead or intraday markets within the time limit imposed in the code. Now, under both circumstances, the market operator is not at fault. You have no claim against the market operator. Its obligations are excused. You as a participant that then also can't perform your obligations are excused, and you are given an additional period of time in order to comply. What about the schedule, and what about the price during this period of time? What our market code provides for is administered settlement, which basically means that you use the data that was last readily available, and then it's actually estimates. When it comes to the tariff, what you would use is the wholesale tariff at that time, unless otherwise indicated by the MGC. This is a slide just showing you that you'll get these, but I'm not going to talk you through them. It's quite boring. But it's just to say that under all 3 of these jurisdictions, you'll see that your relief is very much the same. So all of them have no fault, extension of time to comply, administered settlement. And something that's important in all 3, and for you to just acknowledge, is that in all jurisdictions, as a market participant, what that means is that you bear the principal financial risk of a system risk delay or force majeure event. And that's because the market operator is generally excused from liability, except for what I've said, willful misconduct or reckless misconduct. And what you then do, what there is as well, is administered fallback arrangements. So in our market code, it's called a settlement rerun. And effectively, when the system failure has been overcome, you then rerun the data. And to the extent that there's some recon to be made, that adjustment will be made. The only thing is that you as a market participant take the risk of that, because there is no guarantee that it would replicate the outcome that would have been achieved under normal market clearing. So how do you mitigate your risk? 2 ways: contractually, which is where we come in, and then practically, I think, which is where our colleagues that have spoken to us today come in as well. All right, so contractually, to the extent in your participation agreement with the market operator and any sort of power purchase agreements or electricity supply arrangements that are dependent on the market price or market info, it's important that you look at these things. So firstly, what do you need? You need warranties on data accuracy. Then you need corresponding indemnities for losses due to inaccurate data. You need clauses dealing with pricing and settlement impacts. You need a tailored dispute resolution mechanism that obviously to some extent mirrors the regime that you have to follow under the market code. You also need aligned force majeure provisions and system failure provisions, and the same fallback provisions that you would have under our market code. So that sort of alignment and making sure that there's mirroring and passing through of those risks becomes fundamentally important from a contractual perspective. From a practical perspective, I think a few of the panelists have touched on this, and I have as well. Cybersecurity, that very much sits with the market operator. As an industry, we just have to be ensuring that they actually are complying and doing everything that they should be doing as a market operator as it comes to securing the system. Data accuracy is important. We are given rights as participants in terms of verification of a settlement, querying a settlement, and basically, if you really feel that you have a claim, demanding that there is some sort of rerun of your settlement. We discussed latency of data and the fact that to the extent that that occurs for an event outside of the control of either a participant or the market operator, that obligations are excused. That doesn't mean, though, that in all instances you would be put back in the same overall economic position. Very importantly, and it's what Rob actually stole my thunder, obviously what we've really got to look at is premature and selective disclosure and effectively market abuse when it comes to sharing data once we have an operational market platform. And that will be governed and overseen by the MSU, and obviously it would be, and the framework would be the market conduct rules. Now, in order for the MSU to actually perform this function, they obviously have to be capacitated to perform it. So it's going to be a very interesting time, because even if we have all the rules in place and all the correct contractual and practical mitigants, we still just have to be really agile and, I suppose, just proactive in the way that we actually take steps in terms of how things are actually playing out when there is this sort of abuse as the market commences. Thanks, everyone. Are there any questions? No. 3 minutes.
I have 3 questions.
Oh, no, not to me, Rob.
Yes.
No.
Put you on the spot. So if you scroll back 3 slides about this one. So previously we spoke about how bilateral aggregated PPAs need to be amended for SAWEM balancing and that. But reading that, fallback pricing is a fair bit that perhaps needs to be adjusted. Conscious that it's probably not going to go all the way to the GPPA level, but it probably does at the CPPA level, right? Not just balancing and fallback.
No, so I mean, I think that that isn't a change that in terms of, I think, your physical supply arrangements you'd be looking to make now, unless you were actually entering into a transaction where your tariff is determined based on the market. So where this really, where this would really be relevant, because obviously not all PPAs will be structured that way, is where you have a contract for difference. So if you have a contract for difference and you're using the SMP as your, what is the term? I suppose your base rate. Yeah, your strike price, then effectively this all becomes very important. The only other place I could think for now, I mean, we're all trying to determine, I suppose, what a certain price cap might be, which is linked to obviously WEPs now. When we don't have WEPs, potentially what could that be? Maybe that's where that would come in.
A little Cresco punt. We have SMP pricing up to 99% accuracy. Just checking. Cool. Second question, seriously. So it's 9:59. Send your forecast through, and either Vodafone or Vodacom does what it normally does and says it's not available, or Eskom can't receive your forecast on their side because they didn't pay their bill and their IT system's down. Talk me through where you think the liability sits, because in that scenario, as an example, what I'm hearing from there is it's the market participants' fault, even though it's actually not their fault.
So, I mean, I think that the definition of force majeure is as standard as broad as any force majeure definition. So if you really wanted to, I think you could try and make a claim for force majeure. Do I think that you would be successful? I don't think in every instance. So we're going to see how it plays out, Rob.
But in reality, you need redundancy. You need to have an MTM, Vodacom, and everything else so that you can prove you did everything you could.
It's all the usual stuff. So, I mean, I didn't put the whole definition on screen because, I mean, legal drafting is beyond boring. But it's the whole, like, you had to try and mitigate your loss. It's the usual stuff. So there's that test that you've got to satisfy. And if you don't satisfy that test, then it's your fault that you actually didn't submit your schedule on time. And
In the most difficult question, not relevant to this actually. So Eskom Green launched last week. Very excited to say they'll help every client because they'll know all their data points, metering data points, right? And based on my understanding of most clients, not even the client sees the Eskom metering half hour, only sometimes, not all the time. You obviously rely on your check meter. Under the market code, would that then allow a level playing field that everyone will see Eskom metering points, maybe not the specific site name, or won't get to that level of granularity? That talks to one of your earlier comments.
I think that it would level the playing field. I don't know, Olga, what do you think? Yeah. I don't know if anyone from the audience has a comment on that.
Yeah,
So
I don't know if
happy
anyone
to-
thoughts about how do you make sure everyone has access to the same sanitized data, right? Because you obviously have access to your client data because you've contracted under your wheeling agreement, and that's normal. But in terms of anonymized general data to be able to make informed decisions, if anyone has an opinion.
Okay.
Alex?
Thanks,
Easy.
everyone.
Got away with that one. Thank you. Cool. So I think we've spent in many previous presentations talking about forecasting on the generation side and some of the scary variances that are there. I think, Olga, we presented last time UL Consulting's forecasts. There's been other presentations around you actually tried to forecast under REAP. How accurate would you be based on your obligations? And my understanding is that one of the reasons that Keith and the team have not shared sanitized REAP data is that REAP 1, 2, and 3 aren't that accurate because they weren't really obliged to be accurate. Whereas REAP 5, where there was a bit of a financial penalty, the quality of the forecasts just improved because people are putting effort into it. That's one side of the story. The other side of the story is the demand forecasting. The other bit that the sector needs to know, and in my view, is substantially less understood in the South African environment. In fact, when you look at the IRP, we have detailed analysis of types of technologies and costs and when they're coming online. And we have one market demand curve. And then we have a market demand curve going into the future, depending on what you think the GDP growth rate is. Eskom do show some data at a transmission level for the type of user. Then hopefully you've got a data set for an agricultural company, a mining company, a smelt, and a manufacturer, and you can try and infer the demand profile in a region per month, but it's very opaque. This is also as equally important as the forecasting side. As mentioned, Cresco has a long-term view of the market, which does result in S&P pricing, punt again. But this is the 2030 national energy balance. I think it's the latest up-to-date slide, Olga, that I had. So prove me wrong. There are versions of this depending on the scenarios. This is an average day in the year. Still mostly done by coal and the different technologies. We still see a little hump in the morning, but it really depends on what your future demand will be. If it's in 2024, we have too much energy, like we have today. If you actually achieved what 2030 will hopefully be, because we need the energy for the GDP to grow, we still have a little bit of excess energy in the middle of the day, but we do have some issues outside of those periods. It might not come out so clearly, and we have quite large renewable penetration in the middle of the day, and we're still really battling to meaningfully achieve renewables in the early evening. And we have one line. Now, the system operator needs more visibility than just one line based on historical data points. both tomorrow, the day after, and then obviously for longer term system planning. Now, how do large loads play in SAWEM? So conscious at the moment that directly loads are not balance responsible unless they want to be as by being a market participant. They are, in my view, indirectly balance responsible because of potentially obligations placed upon them by their, in most cases, ESCOM distribution, or eventually once aggregators take on the balancing services by the balancing operation. And we've seen that in other countries. Funny enough, some of the deals that we've seen ESCOM do, we won't go into the names, there's actually already an element of forecasting obligations on the loads around minimum usage because they are doing these deals for certain requests as well as for demand response. So it's quite complicated to say, where does the customer sit? If you're a large industrial user, you'll potentially be an LPU and actively involved as a market participant, perhaps not for all your metering points, but at least for some of your metering points. If you're a co-generator like the pulp and paper players, kind of are an LPU on the load for part of the year, and then you're a generator for some of the year, so you're probably playing both obligations. And then you have commercial customers, so the net cares, the smaller users who are, in most cases, probably going to stay with ESCOM distribution for the medium term until aggregators can offer the similar services or the market is actually eventually unbundled in such a way that balancing will be responsible. But even if you are directly involved or indirectly involved, is a requirement for forecasting. We are conscious that as a LPU, your imbalance price will probably be S&P plus 5%, or eventually the balancing stack. And I think in Mining and Indaba, Olga showed us some presentation from Hungary, and the prices bounce all over the place depending on what the balancing stack is. Or there'll be some indirect penalties for imbalances. It won't probably be the S&P price, but it'll be more than a little slap on the wrist if you get it wrong. Because if the commercial customer gets it wrong, the aggregator will get it wrong. They will have imbalanced pricing. So there will be a flow through either directly or indirectly, depending on the role. To any large load or even small load, and you say to them, you need to forecast tomorrow. They'll give you 100 reasons why they can't. Fortunately, the answer is you have to. Conscious that a single site is harder to forecast than 90 different sites. And different sites have different abilities to forecast. So if you're a hospital group, chances are that not every site will go down at the same time, or not that every operating surgeon area will go down. So you potentially could have small imbalances. If you're a large mining site or smelter, one trip could take 150 megs out of the system quickly, which is material, right? We talk about what on average 1 meg's 1,000 households, size of the house that you live in. So that's like 150,000 people going to dinner that wasn't expected. That's a material impact for the system operator. So with that, where do we see it happening? So this is some lessons learned from the European market. Initially, it was unregulated. Then there was threshold based. This is on the demand side, as well as embedded generators, because in many cases they sort of considered together, because the market operator only sees the net demand coming out, not just the export facility. Eventually, it was all generators, and then we're moving all the way towards real-time visibility as the grids need more real-time data. So as much as at the moment in South Africa, as an LPU, you have direct balancing responsibilities. It's up to you to decide if you want to as an LPU. I see what's happening in Europe and other markets cascading down into South Africa. Probably quicker than in many other scenarios. So maybe CFDs takes a bit longer, but my view is that demand forecasting is going to happen much quicker when we're getting there. And therefore, the whole simulations that Cornel spoke about earlier is important for everyone, not just the generators. Demands also need to understand if they provided a false thing and they compared their actual versus their budget, what potentially would be their imbalance penalties. And then when the aggregator brings them a price point, they at least have some benchmark. So, I think for many loads, many loads already have embedded generators above 10 megawatts through the single site, so there's that implication there. And then we look that over time, the demand forecasting for loads perhaps won't be done by regulation, more done through contractual obligations. That's because the supplier has their own forecast accuracy requirement. The imbalance costs can be pretty low for large loads. And in many cases, large loads have the operational capacity to provide forecasts. How big is this market? So, say South African demand, we think, caveated 17 times, is about 233 terawatt hours predicted for 2026. Eskom announced last year with much fanfare in Q3, they sold 190 terawatts. At 43 terawatt hours that is not being sold by Eskom. Short-term, primarily embedded generation on rooftop, increasingly large bilateral aggregator deals finally coming online. We'll hear all about Envisa and their amazing portfolio soon. But there's always lots of others, Tronoxes, and I know some of the aggregators in the deal have energy that's now running. So that's going off there. So at the Cresco side, based on our client data, generation data, we've sort of tried to split this area, conscious that smaller municipal clients and residential might not be the perfect split, but that's not really our primary focus. But EIG we see is about 32% of the grid, subject to smelters running, so this can bounce all over the place, right? If 2,000 megs drops off, that could move. And large energy users, call it non-EIG, is about 20% of the grid. So for us, 52% of the grid, the market operator needs a lot of visibility on. On the residential side, my understanding is that across 1 million households, you can analyze it down to percentile probability, because on an average day in the year, you switch on your kettle at a certain amount of time, and a number of people go out for dinner. And there's a story about that apparently when Wimbledon is one of the most watched sporting events by the UK system operator, because just before the end of the set, they start ramping up their demand because they know at the end of the set, everyone's going to go and switch on their kettle and you're going to have the spike. So the system operator is not just watching Wimbledon to see if Alcaraz wins it again, they're also using it for predictive demand side response, right? And that's the sort of level that they use in terms of external data points trying to drive real-time demand response. So this is pretty accurate. Commercial office blocks are pretty accurate. It's very seasonal, but the EIG, non-EIG is definitely not seasonal. It's driven to on-site management. And in our view, SAWEM, either today or ongoing, they will have BRP, either directly or indirectly at this stage. And therefore, large loads need to be aware of this. Luckily, most of the clients that I think Cresco works with is very aware of this and already planning to put system planning and process in place. But they're also conscious that you can't buy an off-the-shelf SCADA system or Homer system or any of these other systems out there. In many cases, it has to be a bespoke system off their own bespoke operational data. You can imagine Coca-Cola running a bottling plant where they work on just in time because I suddenly need more Heineken for the weekend because Portugal's playing. That's important, whereas a smelter is running more consistently over the year, their own demand requirements. Some of you might be aware that I'm also involved in a company called Florian. There we're helping on the demand forecasting side. And this is very much going down to what drives the demand. What we've seen, you take AI and you take 3 years worth of actual data and you run it through AI, and AI says, you seem to use a lot of data in December and January. Everyone goes, well, it's the builder's break, right? And all the miners go on holiday. So that's not very helpful. But we need to get back down to basics. We need to understand the mine plan, the production yield, the ROM ton data, the saleable tons data through a smelter, to be able to create a demand forecast. We know that the first demand forecast is going to be wrong. We improve the demand forecast and over time. And in many cases, our client has understood they've got about 18 months to get the algorithm right, get the data points coming in from their operations to create the data points right so they can give proper demand forecasting. One is to help with balance responsibility. And secondly is to mitigate against the excess energy risk from aggregators when we do, in my view, move from monthly to hourly reconciliation. So the question is, the people are getting it, they're planning it, but the other demand side, what are they doing to get ready for the level of visibility that is? Very much. Did I make 6 minutes? All right. Go long. Still no questions? What?
Thank you. Thanks. Okay, before we get into maybe talking about SAWEM, maybe the reason why Rob asked us to speak here this morning. So just a bit of a reflection on Envusa. Fully integrated asset-backed energy trader. So what does that mean? It means we develop projects, we finance them, we construct them, own and operate the generators, and aggregate and trade the energy to the benefit of our clients. Already delivering 520 megawatts across sort of 3 groups of entities as off-takers, and that's from 3 generators, 2 wind generators, 1 solar PV generator in a cluster at the Cruise-on 2, or we call it the Cruise-on 2 cluster at the Cruise-on substation. Yeah, and we're quite proud of it. That was the first implementation of the transaction, which is sort of many generators to supplying to many off-takers through a licensed electricity trader. And proudly South African, more than 51% black-owned, level 4 BE company. Partnerships, absolutely in our DNA. Envusa is formed out of a partnership between its shareholders, Anglo American and EDF Power Solutions, and partnerships remain true in everything we do every day. And actively expanding our customer base. We, I think, look forward to releasing more information about that over the coming months. Before kind of talking about our baseline understanding of SAWEM or what it means for us and how we're preparing for it, I think probably just a good idea to baseline what's happening today. It provides a good framework from which to understand how to prepare. And we're currently in a pilot phase with Eskom on their portfolio wheeling offering. Somewhat of a slight difference from traditional wheeling. I think it will be more available more broadly in the market in the coming months. But the key difference there is a single portfolio account held by Envusa Trader at Eskom Distribution, into which all of the energy from the 3 generators is consolidated. And we make dynamic energy allocations from that single account, and we communicate those to Eskom Distribution, the retailer, on a monthly basis. Eskom then bills the customers, they're their customers and our customers too, and provides credits, wheeling credits, based on Envusa's energy allocations that we communicate to Eskom. Actual meter readings from the portfolio generators, and that's a key one. I'll reflect on that on the next slide. And then, of course, WEP's time of use credits, which is just the approved tariffs and charges through MYPDM and RTP processes. But the key thing here to kind of acknowledge is that the wheeling credits are based on actual meter readings from the generators. Okay, then in terms of thinking about SAWEM and what changes, before I get into this, I do want to just caveat that market code, vesting contracts, wholesale tariff framework are all in differing parts of NERSA consultation processes. So what we talk about here is subject to final definition, refinement, and how that lands. Equally, how Eskom Distribution positions themselves in relation to all of that is also finally to be defined. But we do have a good sense of how this is more or less likely to land, so we can talk directionally with some confidence. I think then to kick off, I think certainly during the transition phase, the base case is that Eskom Distribution retailer still manages the customers or the large power users balancing, at least during the transmission phase. And I think maybe if we have time for questions, we can discuss why that's likely to be the case. But in that context, the customers or the large power users are still billed and credited at month end on a time of use basis. So megaflex, off peak, standard peak, in accordance with tariffs and charges that are approved through NERSA processes. The big shift under SAWEM is that the volume of the wheeling credits for a customer would be based on the trader or the generator's day-ahead declarations, not the metered actuals. So this is a big shift. And of course, in that context, the generator or the trader's forecasting capabilities and strategy for declarations becomes very important. So we can think about kind of maybe the incentive or the excitement to make large day ahead declarations, because we think our customers are going to get higher volumes of wheeling credits. However, a generator or trader, depending how you manage it, will be balance responsible for the difference between what it actually finally delivers and what it declared day ahead. And of course, it has some time to kind of get back into balance during those intraday windows. And to the extent that it has to make use of that capability, it's going to pay over to the market operator. And then any difference finally between its final schedule and actually what is delivered to the grid, imbalances there. Rob's touched on about 5% of S&P is kind of the current direction, and of course applying that to the amount of volume that is incorrect. I think that's of interest, so you've got to think about it. So I think equally on the other side of the coin is that you could have a scenario, given that the likely outcome is that the off-takers remain with Eskom distribution, where off-takers in conjunction with the trader can consider potentially day ahead. We think, let's say S&P is going to be 3 Rand. And we work that back and we understand, okay, if we had to declare that this energy is going under the bilateral to the off-taker, what would be the effective WEPS credit under that basis? And let's say that is effectively 1.50 Rand. You potentially have a scenario there where you are better placed as a group of off-takers and traders to bid that energy into the day-ahead market, collect the 3 Rand less a balancing fee, pay over to your off-taker in almost a reverse CFD basis what would have been their electricity cost savings on a WEPS credit basis, equally deliver them the RECs so that they're in the same position, but you have profit, which you could split between the trader and the generator, or between the trader and the off-taker. Sorry. So again, all subject to how wholesale tariff framework lands, vesting contracts, how Eskom distribution finally does things. But these are the considerations that you can think about now. So yeah, exciting times. I would say then also sort of your day ahead declarations as a trader / generator is going to need to be customer specific. So kind of not just saying we have 300 megawatts to deliver from K2 tomorrow, but equally to which of our customers is that being earmarked to go. And in that context, a trader the trader must know, must have visibility of sort of actual demand and how that's progressing through the month, as well as some level of forecasting from the off-takers. But again, if the off-takers are kind of being billed at month end across 3 time of use buckets, peak, standard, off peak, your day ahead declarations as a trader can be a little bit wrong. And if you're keeping track of what's happening over the course of the month, you've got time to get back into kind of the overall position by the end of the month. Again, some nuances there, but things to consider. And I think, yeah, just to Rob's point, Eskom distribution are working on a system to make available to market participants the Eskom meter data of the loads as well as of the generators, but there will always be the potential for errors in that data. So you're also, as a trader or just anybody in this business, best placed to have sort of immediate access to the off-takers meter installations, the check meters that we refer to in the industry. You want to be working with best available data. Okay, then just lastly, Rob asked if we could share this a little bit. I mean, obviously, in preparation for this, we are doing a lot of work on forecasting, and we're actually doing a little bit of forecasting for Eskom at the moment through portfolio wheeling. And here's just an illustration of kind of forecast in blue and actual in red. And here was where we forecasted energy supply over going on to 41 hours. You can see on the bottom axis there, and you can see how in this instance, illustratively, we were quite accurate for, say, the first 10 to 12 hours or so, and then you start to get a divergence. So all of this forecast happened on hour 0, basically, if you look at this now. And well, I'm not sure exactly what this, as an example, yes. Yes, for the next 40 hours. Yeah. And accurate for the first 8 or 10 or so. And that just illustrates kind of if you're making day ahead forecasts, you're definitely going to have to participate in the intraday windows to update, because you can see how kind of you get deviations going out. But I would also say that an interesting data point for the industry is that, of course, wind is more difficult to forecast than solar. The irradiance is easier than kind of forecasting pressure systems with wind. But even more so than that, the availability of advanced weather data in South Africa is not there as compared to Europe yet. So even though wind is hard to forecast, it's even more hard to forecast here in South Africa currently. So a lot of kind of catching up to do before we become balance responsible. And I guess where there's risk, there's opportunity as well. So there's lots of work to do, but lots of excitement as well. And thank you. That's it for this morning. Okay.
No hands. Okay. I get one over there. I have a quick question for you.
Yes.
So if you had to break that down, EV and wind separately, conscious wind is more difficult.
Yeah.
So P50 is a nice idea.
Yeah.
But some of the limited data we've seen of actual versus budget, P50 outperforms in the middle of the day, but it underperforms at 6 o'clock in the evening. So how do you build that probabilistic analysis into that?
Yeah, it's built in already as part of the forecasting stack. I think, Rob, is that kind of two things. If off-takers are kind of looking into the future, P50 is great if you're looking at a 20-year life cycle, but it's P50, right? So half of the time it's going to be wrong. So if off-takers have sort of the need to meet certain decarbonization thresholds by, say, 2030, they should actually be looking at like a P75 for sort of energy delivery basis, giving more certainty of energy delivery and that sort of thing. I would say there. I think it's also in forecasting energy kind of in a day ahead basis. It's looking at different ways of forecasting, different data sets, and triangulating into the most common answer, essentially, as opposed to kind of just being very narrow in your assessment.
Thank you very much.
Pleasure.
There's a question. Yay, Bunty. Thank you.
Bunty Kireme from Mitsui. In looking at, I think you also mentioned, Rob, the presentation you did where you looked at the hourly, the change from monthly to hourly reconciliation, the variances in your forecast versus actual. If I go to any utility scale plant and I look at the substation, they look identical. Expectations on the data are the same. Protocol with which that data is being transmitted the same. If I look at a CNI in a switchboard, they vary so vastly that the engineering effort to design a plant to tie in is sometimes more than for utility scale plant. In many cases in those projects, you realize you have to replace the whole switchboard. So now we have, with the utility scale case, this kind of variance. What kind of exposure are we looking at when we look at the demand side and we're looking at municipal data that has its own kind of resolution that is submitted with ESCOM tie-in points that one customer might have 4 or 5 different metering points, in some cases on different voltages. How do you deal with all of that? What level of exposure are we dealing with if on the supply side, hourly reconciliation exposes us to X amount, when we factor all of that in on the demand side, what are we sitting with?
I would say that ESCOM distribution or a municipality is essentially a single balance responsible party, but because it has access to sort of many customer accounts, sort of the variability customer to customer is somewhat smoothed over in a probabilistic way. So they're in a very fortunate position, and it comes back to kind of our base case, at least during the transition phase, is that a customer's load is best placed actually behind ESCOM distribution, because it has the ability to kind of smooth out imbalances in an easier way. Whereas if it's kind of sitting behind the trader has just less of a customer base at this stage of South Africa's kind of market evolution. And our ability to manage that imbalance as a trader and kind of move numbers around between different forecasts is not as extensive as ESCOM distribution.
That's the exact case. So balance response balancing group, say a few generating units, a few customers in an area. What kind of exposure there?
Certainly things for traders to look at balancing groups, so collaboration between the large traders is inevitable. In that basis, there'll be a crossover point where if enough traders with enough generation and enough offtake come together and make use of that balancing group through the market code, or the concept of balancing groups through the market code, then we could probably achieve fairly soon the same outcomes that ESCOM distribution could offer to its customers. That's also why ESCOM distribution is looking at still providing this sort of monthly billing on a 3 time of use basis, because it's a very attractive offering for the off-takers. And they want to keep kind of that business and that customer line as long as possible.
But in the European environment, that's why the visibility has been gone down to even like 125 kV level to install capacity. Because if you suddenly decide today's the day you're going to fix your PV array on your commercial building, not only do you tell your maintenance guy, but you tell the system operator too, because they then can build that into their forecast. That's where the level of detail is coming in. Cool. One more speaker, please bear with us. Probably can we go to the speaker and then do the questions at the end? So I think we're going to move away from theoretical PowerPoint to someone who's actually doing it every day. So that's quite a nice change. So good luck. Thank you for taking us away. Mark used to be, I don't know what your position was at Eskom Trading, but you're actually the only person to physically have traded energy across border recently. Maybe you could just speak a little bit about your previous trading experience, if you don't mind, and then link into your experience in SAPP. Thank you.
Okay. Good morning, everybody. Good to be with you all. Very much a change of pace. Please don't ask me anything about SAWEM because I know very little about it. I don't operate in South Africa currently, but hopefully in the future we will. But effectively, we, just by way of introduction, Solar Century Africa is a renewable energy project developer. Good old days, you would develop plant, get it to FC or commercial operation, earn fees, and walk away. Carry some obligation for 2 years, and then you're free and easy. In our wisdom, we decided to become a power company. And by that, we mean we started developing plant for our own, for ourselves. We now, therefore, we still do the development work for embedded generators and so on. But on we also, in our power company guys, we call it our merchant strategy. We are developing plant. We retain ownership of that plant. We fund them and develop them, construct them, own them, operate them, and also trade the power. And we are the first and so far only new capacity added in the Southern African Power Pool region with that sort of mandate. So we currently are trading on the Southern African Power Pool. Being the first is always an interesting and challenging time. But we have learned quite a lot of lessons. So I'm glad the other speakers were very thorough about SAWEM because, as I say, I know nothing, so please don't go there. But feel free to ask anything about SAP and trading in general. But we have a 25 megawatt plant in Zambia that trades on the day-ahead market. And we have a 19.3 megawatt plant in Namibia that also trades on the day-ahead market in SAP. And the 25 in Zambia, within about 2 weeks, will be a 50 megawatt plant. We have various other plants. We are developing a portfolio of 500 megawatts. by 2030. Most of it is already permitted, and that's what we do for a living at this stage. So we have some experience in trading. Prior to that, I think Rob wanted me to say that I was Eskom senior manager responsible for international trade. So I managed Eskom's interface with all the regional countries and all the trading activities and so on. So been around a while. So my slides are a lot simpler, and I'll feel a bit embarrassed, but just bear with me, okay? Yeah, I've said that I don't trade electricity, I trade information. And if I had the hindsight to know what I'd be doing today, I probably would have studied computer science instead of engineering and financial management and all these things. The problem is the HP calculator was about as good as it got in those days. And my first computer had a 20 megabyte hard drive and a floppy disk. So there was really nothing to study in those days. So we've had to learn a lot. But really, and I think the purpose of this is all about data and security and so on. So without information or where there's less certain information, we tend to withdraw and trade less and less, and it doesn't help the market at all. There's sort of two phases of data that we needed when we started up our strategy. And this first slide talks to, before I even joined the market, what do we need, and can I make money in this market? Is there going to be enough volume going through the market? Can I move the power from where I am to where it needs to go? And obviously, what could go wrong? So those are the very, very high level sort of questions. There's about 1 million others that we asked ourselves, but we needed clarity, or we need to be able to see the price data in the SAP. And at the time we were starting, SAP published. Sorry, anybody from SAP in the room? Because I want to apologize in advance. No? Excellent. So at the time we started our strategy, SAP has got a website, and then you can interface with that. It's called sapmarket.com. And they provided hourly market prices, and they even split it up per zones or node to an extent, per country, if you will, or per area. And they provided volume data on the market as well. So you could get some insight, They subsequently, in their wisdom, I think a lot of clever people, better IT than me, started data mining and got a lot more insight and started publishing a lot of reports that SAP weren't providing in the first place. But it was available if you could interrogate the data adequately. And SAP then decided this is now worth money because some other people are making money out of this, we assume. So they took away the volume data. So suddenly, halfway through the process, they took away the volume data, so all we could see were the price. And about a month ago, this was about 2 or 3 years ago, and a month or so ago, if you log on to sapmarket.com now, you'll see an error message because they don't publish pricing even now either. So how do you encourage market participation if you don't know what the prices are in this market, you don't know the volumes going through this market, never mind a whole host of other information that you actually need. So SAP is making itself less and less transparent and visible to potential traders, and therefore, it's bound to be resulting in less and less investment into the pool. But you really need to know a hang of a lot of data before you get into this. And this is just the market data. The way SAP for cross-border trading works, we have a plant in Namibia, as I say. I've got to take that power from the plant to the border. That's a domestic matter. That's got nothing to do with SAP. That is what does NamPower want to do to us to get it to the border. Zambia, same story. How do we get it from the plant to the border? So there's a cost involved, wheeling costs and balancing and everything else. And it's interesting to see that 5% of market clearing price. I would love that. Please put that through SAP for us, because in one country in SAP, and I'm not going to name countries because I've been told I badmouth them, but anyway, one country charges, I'm a pure solar plant, so I've got no storage, nothing with it. In one country, for every kilowatt hour of imbalance, I pay diesel generation. I'm not exaggerating. They take Eskom's emergency energy rate, which is diesel, that they declare to SAP as their emergency support rate, and they impose that on us to balance. Whether or not they are in turn out of balance with Eskom, we pay diesel generation rates. And thanks to recent world events, the diesel price, as you know, has gone through the roof. So my balancing charge was around 35 US cents. And by the way, the market clearing price is 5 cents US, maybe. My balancing cost, if I get my forecast wrong, was 35 cents. Well, last month it was 50 US cents for that same balancing charge. Irrespective of whether, it was, as long as I was out of balance with their grid, that's the charge they transferred through to us. So it doesn't take long to, or it doesn't take a genius, I suppose. If you're earning 5 cents and your risk for every kilowatt hour is, or megawatt hour is $50 $500 a megawatt hour, it doesn't take long to run out of business. So that's the sort of situation in another country that we trade in. The balancing is a lot more it's an annual reconciliation effectively. So overs and unders, I get compensated, and it sort of balances over a year. So a much more amenable approach. But you have to know that in advance before you try and enter a new market. And yeah, some of that came as a surprise to us very late in our investment decision, shall we say. Wheeling charges are double in one country compared to another, etc. So getting to know the environment you're operating in besides the market itself, all of this is very, very critical for us. So just some sort of lessons learned. And hence I say I will gladly take 5% of 5 cents as opposed to 50 cents. But anyway. Moving on from that sort of decision making before we entered into the market even. In real time, SAPP does get a lot better. There is information shared, obviously, to an extent. There was a discussion around forecasting and lesson learned. It's a very expensive lesson in that country, obviously. But forecasting solar is not as simple as it sounds. We were concerned about this, obviously, so we employed 3 vendors, international players that do this for a living, and we thought, oh, we'll be safe, We'll use them. Well, if the 3 forecasts could agree, we might be able to use them, but yeah, it's not an exact science. We have subsequently discovered forecasting solar output is extremely difficult. On average, in December, January, we only started trading this plant in December last year. On average, we were achieving like 6-7% imbalance. But that's only negative imbalance. So we get no compensation for over-generating, and we get penalized heavily for under-generating. And we achieve 6% on average over the month, which sounds great, except at 50 US cents a kilowatt hour. It doesn't sound great at all. Forecast, I can't stress it enough. The more you can do on that, we've now developed our own machine learning stuff and got a lot of youngsters running around doing a lot of stuff. And it's getting better and better. And unfortunately, we started trading on the 16th of December, which is a public holiday. No demand in the region, nothing. The cloudy as hell, cloudy as anything. So, lesson learned. You don't ramp up on the 16th of December because you get very disappointed with your first market result. But, these are all sort of lessons that we've learned along the way. But forecasting, I cannot stress enough, is a critical thing, and it's extremely difficult. Last month, we did 0.4%. So we're learning, but it's still mainly because the clouds disappeared. It's the dry season. So, but yeah, it's a difficult science. But we really need to know, our availability, obviously the weather forecast, the demand, the expected outages, etc. The price, what is the price doing? What's the projection on that? What's likely to be the marginal unit across the region? Because now we're trading across the region. We then need to go into scheduling. So scheduling our requirement for wheeling to the transmission system operator, looking at constraints and curtailment, etc. We then have to submit our bids and offers. Those are confirmed. We submit by 12, and by 10 past 12, we are very disappointed or excited. And then settlement, the metering, the imbalance. And all of this is just data. It's just more data than I can manage, but luckily I have people who can really manipulate it and simplify it. Missing data in all of this just increases uncertainty, increases risk, and makes us more and more conservative and lowers liquidity and time in the market effectively. And in terms of that conservative trading, you do your financial model and I'm going to sell 90% of my power. When you get hit with that kind of balancing charge, you trade less and less and less, trying to get rid of your imbalance because it's obscene amounts of money. So you end up trading 60% of your power. How does that affect your financial model and your business viability, etc.? So the lack of information or lack of certainty around information lowers real-time trading volumes and lower liquidity in the market. I mean, I think I've said all of this anyway, and I promise. Is my 6 minutes up? It's 6 minutes when I started presenting. When Robert said you got 6 minutes, oh, that's so blooming quick. I'll just do a few slides. Then I heard them speak. It's like, wow, it's quite long actually. But anyway, more transparent, lower uncertainty, more market participation, more liquidity, better price discovery, and that's what we all want: is lower energy costs. And you know, I think everybody's told you the information that you need to make these sort of decisions. And it's about information asymmetry. That's why markets fail. So,
Thank you.
that's about it.
I know there are 2 questions, but I have 2 specific questions for you.
I took my 6 minutes.
No, great, but quick one. So when SAP took away S&P pricing and volume, how do you plan?
Good question.
80% of energy in SAP is traded on bilaterals, on special deals done at Harare Country Club, on the side. How do you access data in that market to trading strategy over the longer term?
I mean, you make a good point. I meant to say it, but forgot. I mean, as Robert said, it's actually more like 85, 87% of the energy across SAPs between the countries. But don't forget, it's mainly utilities that we're trying to compete with here. So they've got long-term bilateral agreements. So 85% of the volume going across border is literally through bilateral contracts. So you have no visibility of that whatsoever. So you've got to relying on this little 15% of the market volume to try and determine your strategy and your access to market and whatever. The other problem is bilateral agreements take priority on transmission. So if there's a lot of bilaterals, there's no transmission available for us in the day-ahead market. So how do we make decisions? Well, with great difficulty. Thankfully, I worked for Eskom for a long time, and I sort of know everybody, and I sort of have some history about how they price these bilaterals, but it's all based on assumption. But that's really the power, the cross-border value of energy, as opposed to what we see in the spot market now. It's not informative of what the real value of energy across the border is, unfortunately. So we're just a price taker at this stage, and part of our strategy is multiple routes to market effectively. So we have the ability to sell within Namibia, within Zambia. We have the ability to do cross-border bilateral trading ourselves. And very, very soon, the way the SAP is behaving, that's what we'll do. We're going to have to migrate, and we still want to remain merchant. We're not going to sign 20-year PPAs. We will put ourselves out of the market for a year, do a bilateral with a mine or whatever in country. And the nice thing is, you're not saying, I'll build your solar in 2 years' time, come back. We're saying, here's the wires, here's my price, cheaper than the grid, so take it, sort of attitude. I'll take it off the market, bring it back when the price. But market intelligence is sadly missing.
Very much. Thank you, Mark. So we have 2 questions.
There's a question at the back.
But there were 2 hands first. I saw your hand first and then yours. That's okay. So conscious that we're running out of time. So if you have to run, please sneak off, but happy to do still questions. I think it's to any speaker, I assume. I think earlier. Unless Mark, just to help.
Thanks, Mark. That was great, but it's not to you, Rob. It's actually a question back to your presentation, but basically what came out of the investor presentation as well. Noted in yours, you were alluding to the fact that maybe aggregators take on balance responsibility for some of these large power users. I'd love to understand why you think, what's the incentive on us to do that in the first place, when the distributor still has the responsibility to provide that service to them and they're not charging for it currently. Maybe secondly, the question there was, as things open up, is it not really when full retail competition comes in and you can take full responsibility for a client's entire account as opposed to supplying them some of the energy from wheeling, where that shift would really happen?
Yeah. So I guess it's coming from 2 sides. So one is, where do aggregators make additional revenue? Aggregators when they become traders, right? When you have a market. So not an aggregator, is now a trader, has been promoted. So I would see that happening in 5 years' time, roughly. But you need liquidity and you need a proper balancing market before you can actually offer balancing services. At the moment, Eskom distribution is only the only real player to offer that. So it's not tomorrow. It also needs the tariffs to be fully unbundled, because you need to get an Eskom distribution bill just for the wires, not currently structured, where they keep on saying this is sitting in there and you're not sure, and pens are there. So it's probably 5 years away. So for our view, 80% of people will still get balancing from Eskom distribution unless you decide to do it yourself, right? An LPU or a thing. So that is the long-term view. It's also driven by the fact that if you look at internationally, you don't make money out of selling energy, you make money out of providing services. Aggregator, and that's part of it. And then hopefully that would incentivize the aggregators who are now being promoted to traders to invest either directly or indirectly in flexible generation to be able to provide the balancing. So it's not a short-term view, a long-term view. Cover the question. Cool. There's a question on the left, and then I think one right at the back, and then that's us for today. Alex.
Thanks. Miranda Skaka from Globalec. I understand that under bilateral contracts, you can't adjust yourself at intraday. So to me, that increases your exposure to balancing charge, especially within the first year where you're still trying to build up your capability or increasing the accuracy of your forecasts. So how would you mitigate against that?
I'll have a go at answering the question, and then if anyone wants to supplement. So I think we need to differentiate between balancing obligations and obligations under your bilateral, right? So under your bilateral, you have the contractual relationships. You don't have to top up daily under your contract, which most contracts aren't. You have more of a period, then it's up to you to sort that out. Balancing, you would still have to play in the market to get yourself out of the imbalances, hence the intraday that Ron spoke about. And in that scenario, as an individual generator, you might be in the market, but it's unlikely you, individual generator, can truly be effective. And you will have this concept of a balancing group. May or may not include demand, and they will, on behalf of all the generators, take a view into the intraday market from a flexible point of view. So I think we just need to differentiate between the two from an obligation point of view. And I think that's where it's quite confusing to sort of the average person out there when they go, oh, bilaterals now need to trade in the market. No, they will continue for 20 years should you want them to, or adjust them in time, but the balancing obligations will happen.
As a bilateral generator, you do have access. As a bilateral off-taker, behind Eskom distribution, it'll be interesting to see what Eskom distribution does, but our expectation is that they won't require sort of hourly forecasts from the loads. We spoke about it earlier, but their ability to manage their portfolio across the country really require that. It is just that they may ask the generator/trader to indicate of day-ahead declaration what energy is going where, because it does allow them in a soft way to manage their commercial responsibilities, their sort of requirements in the wholesale market. A load is 50 megawatts and Envusa is supplying 30 megawatts. That load, essentially in that hour, they need to go buy another 20. And manage their responsibilities month on that
basis. I think they will ask for hourly. They're already asking for that because they need that granularity, specifically for larger loads, right? Not for you and I as an individual, but if you're a smelter or a mine with a 50 megawatt, they want that granularity. Forecast from the load. Market version 7.5. Cool. I think there's a hand right at the back, and then I think that's the last question, and then Alex will close. Thank you.
Tianda from RMB. I guess my question is to the last speaker, more around we're seeing as financiers, players in the market considering, players in the SA market considering SAP as an alternate route to market. Will these two markets eventually be integrated? Is there any value in considering the integration of the two, the SAWEM and the SAPP, now in how the SAWEM is actually designed at the outset? or is that redundant? I mean, is it duplication if you consider that? Because SA is already a SAP member, and some of the regions are interconnected already. Would it be duplication, or is there additional benefit in actually integrating those two markets?
If I got the question, integration of SAWEM and SAP, and whether both or is that? Good question. And I need to do more work on that, frankly. But my understanding is from slides I've seen, the SAWEM will run the market, determine its surplus and deficits, and offer that into the SAP. So SAWEM will close earlier than SAP, and then the balance will be traded into SAP by, I assume, the market operator. But I believe there's also an opportunity for IPPs to get direct SAP membership and trade directly on SAP as well. Direction from the people involved in SAP, but that's my understanding. Whether it's a good idea or not remains to be seen, but technically it's quite possible. And
they do interact, but there's no reason to merge them. It can't really exist from an infrastructure. App deals with SAWEM deals with power transmission. So the market operator takes all bids, offers, optimization algorithm, automatically creates the balancing pool or the requirement, and then generates a net or export curve. So it will automatically decide what's the best outcome for the best price and take or offer into SAP. Complementary, they can act, but they
Alex, we'll finish. And just to confirm, if you registered, you'll get the recording and the slides and everything afterwards.
Saying what I was going to say. No, so everyone, thanks for joining us this morning. Know you probably have a packed schedule, so we appreciate it. Please do stay and continue the conversations. There's some breakfast, coffee, tea, and hope to see you again next year. Thanks.